isn't there a risk, of a faster wage growth than you're assuming here, given that the experience of inflation over the last 5 years has been close to 3%, and people are now looking at somewhere between 5 and 6% over the year ahead?
Well, we've done a lot of talking around businesses and around unions, and the picture we're getting is of recovery in the labour market, but from a very low base and quite realistic expectations. So while we'll absolutely watch that carefully, we're not expecting wage demands to jump away as a result of that GST story, no.
Are you still expecting to increase the core funding ratio to 75% over the next couple of years?
Yeah, well, Bernard, I don't want to go into that in detail because this is about monetary policy, but broadly, yes, but continuing to watch the impact on liquidity and on bank balance sheets.
And what sort of financial crisis or meltdown would you need to halt your current track of increasing of the official cash rate? How serious would it need to be? What signs should we look for?
Well, we're not looking for any of this. We're expecting, in a reasonably confident way, to see the world economy to continue to grow. But, of course, we will be watching European financial markets, and the sort of things that we would look for would be any impact that either increases funds in term markets or freezes up term markets in any significant ongoing way, any loss of confidence more generally around the place, any concerns into financial markets that made them look more closely not just at sovereign risk but external vulnerabilities, and anything that impacted through on the trade channels, so reduced New Zealand's exports. That's a long list, but we don't actually think those things are going to happen.
Just outlining the main indicators that show that we are in a positive economic growth for me?
Yeah, GDP. It's been growing for the last year. We haven't, of course, had the last quarter's figures, but we've got components of those, and those continue to look like they're going to contribute to significant GDP growth this quarter. If you then go through, you'll see a more patchy recovery underneath that. So there's some recovery in the housing market, but it's cautious. Business investment, only cautious. However, export receipts, very strong. And as I said, some remaining government expenditure stimulus, but that's gradually coming off. But we now think that that recovery is broad-based enough to be reasonably confident about it. We don't see it as the fragile first steps out of recession. However, having said that, it's only later this year that we get back to a GDP position that we were in before the crisis, so recover that lost income.
You seem to be putting a lot of store in export receipts. Are there any question marks about how much of a boost that will deliver to the economy, given the very high levels of debt that the farming sector is carrying and pressure from banks to pay that back?
Yeah, I mean, we are putting a lot of store in it, and of course, because we're getting record export prices, record terms of trade, that's very good news that shouldn't get lost in the general concerns around things like European financial markets. That's flowing straight into New Zealand, muffled only by the exchange rate, and into farmers' pockets. Farmers generally are deciding to reduce debt. We think that's broadly sensible. It does reflect the fact that particularly in the dairy sector there was a lot of debt taken on in that first peak of dairy prices around 2007. So I think that leaves them in a pretty solid position. So we're not seeing it all going straight into consumption, which would have led to a faster pickup, but we are seeing it going into a more balanced situation where debt is reduced, not just by farmers but by households and businesses as well.
Do you see any concerns around just a general lack of business investment? I know you expect it to pick up, but that might flow through to a more rapid improvement in the jobs market. That might put more pressure on inflation?
Well, I mean, we do expect to see business investment pick up, and New Zealand needs it to pick up. And a very important indicator there will be what happens to business credit growth. which has been declining, and we do need to see businesses borrowing and banks lending for sensible stuff. We expect that to happen, but we'll certainly be watching that, and banks, of course, have got a role to play in all of this, bearing in mind that many of their customers are very cautious after what they've been through now.
You've said that you expect recent tightening in lending standards to ease over the projected period. What makes you think the banks would do that when they've got their core funding ratio rising to 75% and the prospect of increased capital controls internationally?
Well, banks want to make money, and the way they do that is by lending to customers, and they can't afford to be in a situation where their balance sheets reduce and they're not actually actively out there in the marketplace, and we're hearing that from banks as well. It's in their interest to do that. In terms of, we've talked about core funding ratios, we actually don't think that that's a big impost on them. And in terms of prospect of tighter capital requirements, well, Basel, what's loosely called Basel III internationally, there's a lot of work going on, and they are likely to reach some conclusion about quality of capital worldwide. We don't expect it to have a very big effect through on the New Zealand market, and it certainly doesn't hurt the competitive positions of Australasian banks vis-à-vis their Northern Hemisphere competitors.
You said that in this tightening cycle, the extent of the increase in the OCR is going to be less because of floating mortgage rates and higher bank funding costs. Can you give us an idea of how big that extent of the reduction in the increase is?
Oh, good heavens. The extent, how big the extent of the increase in the reduction? That's third derivative, Bernard. Do you really want that in a press conference?
So according to your 90-day bank bill track, you're going from 2.5% to around 5.5%, 6%. Last time you went from just on 5% to 8.25%. That's the 3% increase. It sounds like you're doing a similar sort of increase just from a lower base.
Well, I mean, as I've said, we are removing or decreasing, and if you want all the stuff like this, increasingly removing the stimulus that's in there through the official cash rate. That's our main focus at the minute. Yeah, we've got a 90-day track in the publication which heads up towards 6%. That you've got to remember that maybe an enduring wedge between the 90-day track and the OCR track. It doesn't do that for a little while, and there's, of course, some uncertainty around those out years. At the minute, we are looking at a picture of gradually removing stimulus.
There are some warnings that the rate rises too early and business recovery is perhaps far more fragile than it appears. What's your response to that?
Yeah, I mean, we've noted a number of groups and lobby groups suggesting we should hold off for a while. That might be in their interest in the short term. I don't think it's in their interest in the medium term. We don't expect to get a lot of applause for starting to tighten now, but on the other hand, I think New Zealanders would be pretty disappointed if a year out we suddenly had to really start pushing up rates because we were behind the inflation story and they were starting to see savings inflated away. So we're taking a medium-term view on this, and that's what we're required to do in the Policy Targets Agreement, and that's why we're here. So I don't expect everyone to agree with this. It's been very well signalled. Actually, we've said we're going to do this about now for the last year, so no one should be surprised in it at all. Thank you. Any more questions? Well, thank you very much, ladies and gentlemen. We'll see you in a quarter.